Right. Good afternoon. Let's give folks another few moments to come on in from the waiting room. All right. While we're waiting for more people to join, I'm just going to give a few announcements. Good afternoon. Thank you for joining us for Making a Plan for Debt. This program is part of the Financial Skills Building Series, which is an ongoing collaboration between the San Francisco Public Library, the San Francisco Office of Financial Empowerment, and the San Francisco LGBT Center. My name is Jonathan, and I'm the personal finance librarian at the library's Business Science and Technology Center. I wanted to highlight a couple of great upcoming virtual events that we have in the next couple weeks. Excuse me. So tomorrow at noon, we will have estate planning attorney Marlon Schultz with us to discuss estate planning and how to avoid probate in California. She'll go over how to build an estate plan that fits your family's needs, what to expect if you don't have a plan in place, and tips for finding the right lawyer and maintaining your documents. You can walk away with practical tools to save your loved ones time, money, and stress. And there will also be a Q&A session at the end of the presentation because we know folks have a lot of questions about estate planning. Then on Thursday, November 20th, come learn about Medicare supplemental insurance and how to navigate your options with Weiss Financial Ratings. We'll cover what Medicare does and does not cover, what options you have to fill the gaps in coverage, how to pick a Medigap plan that is right for you, and how to compare rates, locate the best insurers, and find authorized agents with Weiss Ratings. Weiss Ratings is a financial and consumer information database that the library subscribes to that you can access for free using your library card. Using Weiss Ratings, you can create a report that compares prices based on your age, gender, and zip code. You can visit this website and click on the Medigap tab for more information. And library staff are always happy to help you if you have any questions or you need help accessing this library resource. So one important thing to know about Medicare supplemental insurance is that while the federal government regulates what is covered by different types of supplemental plans, it does not regulate the cost. And this can lead to wide price differences for essentially the same level of coverage. So you can go to that link there if you want to explore Weiss Ratings and create your own report comparing Medicare supplemental plan prices. So in addition to providing year-round programming on topics to help you navigate the financial landscape and make better decisions with your money, the library also provides access to other helpful resources like Weiss Ratings to meet your current needs and plan for your financial future. You can visit sfpl.org/BST to find out more about our business and finance resources. And you can also subscribe to our once-a-month email newsletter to stay informed about programs like this one. And I'll share all the links from my brief intro here in the chat in just a moment. Now I'm going to stop talking and hand it over to Andrea from the San Francisco Office of Financial Empowerment. Thanks, Andrea.
Thanks so much, Jonathan. Appreciate it. And welcome, everyone. Thanks so much for taking the time to join us today for San Francisco Financial Counseling's webinar, Making a Plan for Debt, in partnership with the San Francisco Public Library. San Francisco Financial Counseling is one of the flagship programs of our Office of Financial Empowerment, which is actually a unit under the umbrella of the Treasurer's Office here in the city. Our Office of Financial Empowerment works to convene, innovate, and advocate to strengthen the economic security and mobility of all San Franciscans. My name is Andrea Yee, and I am the Financial Capability Program Manager for our office, and I lead our San Francisco Financial Counseling Program. Some of you may know San Francisco Financial Counseling as Smart Money Coaching, which we used to be called before. But generally, the program provides free one-on-one financial counseling to anyone who lives, works, or receives services in San Francisco, and that's regardless of immigration status or income bracket. So yeah, we really try to make sure that our service is open to as many people as possible. San Francisco financial counseling services are funded by multiple San Francisco city departments, and the services are provided by different service providers who have experience in providing financial capability services to various communities throughout the city. The SFLGBT Center is one of those service providers, and our financial counselors joining us today are from the SFLGBT Center. But before I introduce them, just a couple of housekeeping items. This is going to be a interactive presentation, so feel free to submit questions through the chat. And I think we'll do our best to answer those questions as they come in, or we'll make some time at the end to address them as well. This session is being recorded, and I'll make sure that I get the recording and the slides out to you all who registered for this event, either later today or sometime tomorrow. And then we'll also send you the flyer so that you can register for our next session. But without further ado, let me go ahead and introduce you to today's presenters. Tori Tibbetts was raised in the Midwest and brings a grounded client-first approach shaped by years of housing policy work, political organizing, and campaigns across the Bay Area. They hold a master's degree in urban and public affairs from the University of San Francisco with a focus on affordable housing policy. Andrea was born and raised in South America and earned her degree from Caracas, Venezuela. She has over 10 years of experience in business and corporate law as a legal assistant and legal business advisor. She's passionate about combining her interest, career, and her background as a native Spanish speaker to empower others in her community. Tori, Andrea, go ahead and take it away.
Everyone, thanks for joining. Just pull everything up really quick. Great. Everyone, thanks so much for joining today in this presentation. We're going to talk about making a plan for debt. As Andrea mentioned, my name is Tori. I'm a financial counselor with the center, and some of the workshop goals that we are going to cover today is we are going to cover the understanding the fundamentals of debt. We are going to talk about how to avoid some common debt spirals. We're going to discuss some debt repayment strategies and also talk about some other debt tips and tricks. So starting out, what exactly is debt? So debt is money that you owe. It is money that you need to repay and money that is borrowed from different creditors you may have. So when you have debt, there are some things that you want to understand. So first of all, you're going to want to understand exactly who it is that you owe. You're going to want to know exactly who your creditors are. You're going to want to know exactly how much it is that you owe them. You're going to want to know exactly how much the payments are each month. You're also going to want to know what the payments, when the payments are due, and other important factors about your debt. There's also a number of reasons why people get into debt. It may be that they purchased an asset, such as a home or a car. It may be that they paid a bill or as a result of not paying them. It also may be to cover an expense or an unexpected emergency. It may be also to buy something that you want or need. And there's a number of ways that debt can impact your financial situation. When you have debt, you have to use future income to pay for your debts. We call this obligating future income. And also when you have debts, there's also interest and fees that you have to pay on top of that principal until that debt is paid. And these debts can impact how much or how quickly you can achieve your financial goals. Now, if you find yourself in a situation where you are having trouble reaching your financial goals because of debt, there are some ways that you can take action. And the first thing that you'll want to do is you'll want to take stock of your values. You'll want to ask yourself, what are the people, places, and things that are most important to me? And then you'll want to look at what exactly did you spend your money on today, this week, and this month? And did your values and your spending align? And then all of this is leading up to creating a spending plan. And this spending plan is going to be like a map to reaching these financial goals. And you are going to be like the captain of your financial ship, where these goals are the destination at the end, and every dollar that you come in contact with is like a milestone on this map. And you want to make sure that you're leaving room for error. Because like I talked about with those emergencies or those unexpected expenses that you can lead to getting into debt, you want to make sure that there's room for error in your spending plan, so that you don't get completely thrown off track when you're trying to reach these goals. And I forgot to mention at the end, if you do have any questions along the way, we are going to go ahead and try to save those for the end. So if you want to just put those in the chat, we're going to go ahead and answer those at the end. So with goals, and when you're trying to take action on these, a really great trick or a great place to start is you want to start by recording every dollar that you spend for 2 weeks. And you want to really practice in particular saying no, and preparing yourself in particular for one really big no. And this is a great way to start identifying temptation. Because as we all know, it's not hard to spend money in San Francisco or in the Bay Area. There's lots of different ways to do it every day. And this can be a great way to identify exactly where you have those temptations. And some tips that we have for this is to write all of them down. Every single time that you spend money, just mark that down. You can also post them or share them. It's known that if you involve someone else in goals that you have, you can actually people are more successful in reaching those goals. This can also help you focus on if your spending is aligning with your values to start tracking all of the ways you're spending your money. Now, what exactly are you putting in your spending plan that's helping you reach your financial goals? Well, the two main things that you're going to be putting in there are your income and your expenses. And the expenses are going to be broken down primarily into fixed and flexible expenses. And we're going to talk about those two things. So there's many different types of income. There's earned income, which is generally taxed income. And there's going to be income from assets or investments. There's also public benefits or entitlements that pay money. There's also other benefits or other entitlements. And then there can be other forms of income, like gifts or money from friends or family. There's also gross and net income. So your gross income is going to be your total income without deductions. So your deductions are going to be anything, your deductions are going to be things like your health insurance that comes out. It could be like union dues if you're a part of a union. And then your net income is going to be the gross income minus all of those deductions. This is what you actually have to save, share, and spend. You may have also heard this referred to as your take-home pay. Now, there's a number of different ways that we can think about our expenses. The three most common are needs, wants, and obligations. So your needs are going to be the things that you absolutely have to live. These are going to be things like food, water, and shelter. Your wants are going to be things that we really like to have, but you could probably go without if you had to. Now, your obligations, which we're going to talk a lot about today, are the debts that you owe. And the main things that you want to think about when you're thinking about expenses and in your spending plan are you're going to be thinking about economizing and finding ways to use less, finding ways that make your needs less expensive, to use less money for your wants, and to negotiate lower payments for those obligations. Now, there's a number of ways to, you're going to want to consider every single expense that you have. So for your fixed expenses, these are ones that are going to be the same every single month. These are going to be things like your rent. And then there's also periodic fixed expenses. These are things that are still fixed amounts, but are not necessarily monthly. There's a number of different insurances that fall in this category, or things like there's also flexible expenses too, which change month to month, things like groceries. There's also revolving expenses, which are obligations to pay creditors for goods and services bought on credit. These would be things like your credit card payments. There's also different benefits that can come from tracking your expenses. This helps you understand if you're using money in line with your values and your goals. This can help you uncover where you make changes, and it can also help you spend less money. Now, there's a number of different ways where you can find where you have expenses. So you want to collect all of your bills. You have your utility, insurance, and all different ones. You also want to look at your bank statements and your credit card statements. You can also pull records like your car registration or school supplies for estimated amounts of periodic expenses like those. You also have different benefits for managing your expenses, like it helps you avoid late fees or interest on unpaid balances. You can also avoid negative credit report entries and also loss of services and the additional charges that can come associated with the loss of services when you have to pay to have those put back on. Now, what if you end up coming up short? If you budget everything out, but you end up not having enough money to cover your expenses. There's two options that commonly you can have to approach this. You can increase your income either on a temporary or permanent basis, or you can lower your expenses on a temporary or permanent basis. This will all come down to what fits your goals and your values. Now, if you decide that you want to increase your income, you can either find a second job, you could decide within your current position to either work more overtime or negotiate a higher salary or wage. You may decide that you want to sell assets like a car or sell assets through a yard or garage sale. You may decide that you want to teach a skill, craft, or activity. You might want to charge rent if you have adult dependents in the home, or you might evaluate tax withholdings if you are receiving a current tax refund, but you still want to keep a balance so you're not getting a tax bill at the end of the year. Now, if you do take the decreasing expenses route, you might decide that you want to prioritize certain needs over wants, or maybe reduce certain wants altogether, like buying clothes regularly, or if you have a gym membership, you might decide to cancel that. You also may decide you want to cancel or downgrade certain services, like you might call your cable company and negotiate with them for a lower bill. Or you might limit miscellaneous spending, and a good way to do this is by sticking to a shopping list when you go to the store. You can also reduce debt, which we're going to talk about different approaches to, like paying off a loan or a credit card. You can also seek to move to more affordable housing or change your insurance coverage for lower premiums, but we want to make sure that you never cancel insurance as a way to save money. Now, there's a number of different budgeting tools that you can use. You can use the notebook method, which is where you very simply just write down all of your expenses in a notebook. You put your income at the top, and then you just write down every single thing that you spend in the month, add it all up, and you're able to track and see whether your income is matching up or is more or less than your expenses. Very simple approach. There's also the envelope method, and there's a variety of different approaches to this. You can have where you keep all of your receipts in an envelope and either break it up or add them up at the end of the month. There's also an envelope method known as cash stuffing, where you take out cash amounts for your flexible expenses, and then that is the amount you have to spend for the flexible expenses in different envelopes. There's also the statement method, where you use one card for all your expenses and track them on a statement. There's also a variety of different tracking apps that you can use that are available in either the Apple or Android App Store. There's a variety of different paid or free options. I also encourage people to put in the chat any options they're using, because there's a bunch of different ones that you can use. However, your budgeting method is only valuable if you use it. So I really encourage people to find what works for them, because you can create the best budget you can imagine, but if you don't use it, then it's not actually going to be helpful at the end of the day. Now, you might be wondering, I don't actually know how much is recommended to spend on these things. And that's totally valid. There are general recommendations that are made for these things based on national averages. And so this is a general spending breakdown where it recommends to spend about 35% on housing, to spend about 10% allotted towards putting in savings, other expenses at about 25%, transportation at 15%, debt at 15%. That's paying towards debt obligations. Now, we have a little bit of a practice here where we are going to play financial counselor for a little bit. We have a client who came in and needs help balancing their budget. So we have here their expenses. They have rent at $1,100. They have a cell phone bill that's $100. Their groceries are at $400. Their student loan is $150. They have a chiropractor, which is $100 a month. So their total expenses come out to $2,500. However, their net income is $2,400. So they're facing a monthly shortfall of $100. Now, I encourage everyone to put into the chat what they would recommend to this client to work on this shortfall and get themselves to a place where they would have a $100 surplus at the end of the month. How would you recommend that this person balances their budget? Are there any recommendations that anyone has? It's okay if there isn't anything, we can discuss it if not. Maybe find a new cell phone plan, yeah. Yeah, I'm seeing stop dining out, yeah, stop dining out. Yeah, I'm seeing decrease dining out. Yeah, all these are great options. Yeah, I'm seeing lots of great options with stopping cable. Yeah, decreasing the cell phone plan. Yeah, all of these are great suggestions. And I will admit, this was a little bit of a trick question, because one thing is, as financial counselors, we will never give you one suggestion, or we will never tell you exactly how you have to spend your money. Because as I discussed, it always comes down to your personal values and your personal financial goals. The main thing is it's about helping you understand your spending and offering different solutions so you can reach your goals. Because this person may decide that what they ultimately want to do is increase their income. And so you never know exactly what someone wants to do to ultimately reach their goals. The main thing is that you are tracking your spending, you're taking control of your finances, and you're balancing your budget so that you can reach those goals. But these were all great suggestions, and it's great to get thinking about these kinds of things. Back to here. Okay. So now getting back into more conversations about debt, we are going to do a little bit of debt lingo. So I'm going to read the whole question and the answers. And then if you want to put the answer into the chat, we can have you answer there. I'm just trying to pull up the chat smaller so I can see it. So for this first one, a loan with collateral that the lender can take if the loan is not repaid according to the loan agreement is A, principal, B, secured loan, C, annual percentage rate. Do we know what this one is? I see a couple of people in the chat already. Yes, I see a lot of answers. Yes. Yes, that one is B, secured loan, correct. Okay, so now 2, we have how much money you borrow. A, principal, B, interest, C, fees. Put that answer in the chat. Give people a second to answer this one. Yep, it looks like we're in agreement on this one as well. This one is A, the principal, how much money you borrow. Great. Okay, for this third one, the main cost of borrowing money. A, current balance, B, interest, C, credit. What do we think is the answer to this one? Okay, yeah, so we have a couple answers to this one. Yes, so this one is going to be B, interest, correct. Okay, great. So then the next one is a credit agreement that allows you to borrow money from time to time up to a pre-approved maximum credit line. A, installment loan, B, revolving credit, or C, a lease agreement. What are we thinking on this one? Seeing a couple answers coming in. It seems like we're thinking B for this one. Yes, this one is B. This one's revolving credit. Okay. So now we have the total cost of credit on a yearly basis. We have A, annual fees, B, annual adjustment, or C, annual percentage rate. What do we think about this one? Okay, we have a couple C, we have a couple A, one all the above, some more C. Yeah, so this one is actually C. This is the annual percentage rate. But I can see how you may have thought annual fees for that one. But yeah, this one is actually annual percentage rate, C. So now this next one, when you borrow a specific amount of money and repay it over a set period of time, is this A, revolving credit, B, principal, or C, installment loan? Yeah, I'm seeing C mostly for this one. Yeah. Great. Yeah, this is C, installment loan. Good. And then this last one is a loan with no collateral. A, secured loan, B, unsecured loan, or C, mortgage. Great. Yeah, we were all fast on this one. Yes, this one's B, an unsecured loan. Okay, great. Thank you everyone for playing along with those debt lingo questions. So we're going to get a little bit more into some of these. So the first is an installment loan. So we have, this is a loan where you have the principal, which is the amount that you borrow. You're going to have a very specific term of how long you have to repay the principal and the interest. And you'll generally pay the same amount for every payment unless you have a variable or adjustable interest rate associated with the loan, which you will know when you take it out. Then you have revolving credit, which you will have a credit limit, which will be the maximum amount that you can borrow. This, your payment will be based on the amount of credit that you used, and you will also have generally a minimum payment, which is about 1 to 5% of the outstanding balance. A common example of revolving credit is, of course, credit cards. Now, you will also have, there's also fees generally associated with debt commonly. Then these are additional charges that are not interest. And you want to make sure that you always understand fees that you will be charged and fees that you may be charged. And a good example here are prepayments. And so this is when you make early payments to all or part of a loan. And this can, of course, help you reduce interest costs, because you won't be charged interest on something you've already paid. And this can mean an earlier payoff date. However, when you talk about fees that you may be charged, you want to make sure that you understand if there are any fees for prepayment when you have a loan, because sometimes those do exist. And there are two main strategies when it comes to reducing your debt. And that's the avalanche and the snowball method. So the first payoff method focuses on paying off the debt that is the highest cost to you. That's those with the highest interest. And then there's also the snowball method, which focuses on paying off the debt with the lowest balance. So with the avalanche method, some of the advantage is that you save money. However, the disadvantage is that progress may feel slower. So you take all of your debts and you list them with the highest cost or the highest interest rate first, and then you pay the amount due, meaning the minimum balance or the minimum payment on each one. And then you take an extra payment, which this would be based on budgeting out and figuring out how much extra you can pay on each one. And then you apply that to the first debt on the list. And then after you pay off the first debt, you make an extra payment on the next debt on the list. And then you continue on as needed until you paid off each one. Now, the snowball method, one advantage is it makes progress faster. However, a disadvantage is that you may pay more money. So you start by listing all of your debts with the lowest balance to the highest. And then you pay the amount due on each debt, and you make an extra payment on the first debt on the list. After you pay off the first debt, you make an extra payment on the next one on the list, and you continue on as needed until all of them are paid off. Now, there are two other payment methods that are very common. However, we do advise caution when approaching these. So the first one is debt consolidation. It involves taking out a new loan to pay off other debts. However, we advise that this does not address the underlying causes of debt, because it doesn't necessarily involve addressing your values and goals and addressing kind of the spending that may have led to getting into the debt. And then there's also debt settlement, which involves working with creditors to accept a lower payment to settle your debt. And with this, the caution here is that you may have to pay income tax on the portion that was settled. Now, if you have debt that you take on and you remain current on it the whole time, the life cycle that you will see is that you take on the debt, you pay it on time as agreed, and then you eventually pay it off. Now, if you take on debt and you do not remain current on the debt, this is the life cycle that you will see. So you take on the debt, there are missed payments, and you become delinquent on the debt. That leads to default, and then eventually a charge-off where the creditor rules it as a loss, and they will either sign it or sell it to a collections agent or a debt collector, who is then responsible for collecting on your debt. And this is the process that you will see if you do not remain current on debts. Now, what exactly happens if you do not pay debts on time and as agreed? So there's several things that can happen in this event. You can face late fees or more money in interest. You can be contacted by debt collectors. You can lose services, as mentioned previously, and have to pay costs to reestablish them. You can also lose collateral. There's a number of other things that can happen. There can be negative entries on credit reports and drops in credit scores. There can be lawsuits from creditors and wage and account garnishment. Now, in a conversation about debt, we did also want to talk a little bit about credit reports, as they are a vehicle where a lot of information about borrowing is reported. And so you do have access to free credit reports every 12 months from each nationwide credit reporting agency, Equifax, Experian, and TransUnion. So you can go to a website called annualcreditreport.com and fill orders for each of these credit reports. We do advise you, though, to watch out for imposter sites to annualcreditreport.com, and also sites that may tell you that they are offering you free credit reports, but can often end up charging you. This is the website where you will get access to the free ones every 12 months. You do also have a right to additional free credit reports in a number of different situations, such as if you receive public assistance, if you're unemployed and looking for a job, if you've been the victim of identity theft or financial fraud. There's also state laws that provide for free credit reports, and in the situations if you've been denied credit, an apartment or employment or some kind of service. And now, what exactly is listed on your credit report? So a number of different things, like some identifying information, your debts and some bills, public record information, and application for credits and other inquiries. Now, the reason why it's important to check your credit report is that they are not perfect. There are errors that can show up. There can be identity errors, there can be incorrect reporting of account statuses, there can be data management errors, balance errors, and outdated information. So it's really important to check them. However, there are time limits on negative information that can show up if you do get negative entries on your reports. They can generally only be reported for 7 years, and this reporting will usually start about 180 days after you stopped paying on the debt. And bankruptcies are on credit reports are different though, and they are on credit reports for 10 years. Now, if you do find that there is an error on your credit report when you check it, there are 2 ways that you can dispute an error. That's online and by mail. And when you do make this dispute, by letter, if it's online or by mail, you want to include your complete name and address, and you want to make a very clear description of every item that you're disputing and the reason for each dispute. And you also want to make a request for either the correction or the removal of the item. You also want to include all of the supporting information that you need to support what you are asking for. And if you're doing a letter, a physical letter, you want to make sure that you are sending copies of the information, not the original. And you'll want to include receipts, account statements, checks, and any screenshots of transactions or bill payments, anything that is going to support your case to either the correction or the removal. And after you file the dispute, the credit reporting agencies have to respond to your claim, so they will send you a letter, and the incorrect information can't be put back on. So you want to check to make sure that it hasn't been. And also, if there's anywhere that received the incorrect report, you can request that a notice of correction is sent to them. So now, getting back to paying debts, before you make a plan to pay a debt, you first want to make sure that you actually owe that debt. You also want to make sure that the statute of limitations has not expired on that debt, and then also that you're dealing with a legitimate debt collector, as we know there's a lot of scams out there. And if you have those 3 items, you know them, you want to make sure that you pay that debt in full if possible. Now, if payment in full is not possible, there are still things that you can do. You can set up a payment plan, but you want to make sure that it is a plan that you can afford. You could also negotiate a lower balance. It's important in this case, though, that you ask for paid in full and not settled. This just looks better on your credit report. Now, if you are engaging with a debt collector, there are certain rules that they have to follow. They can't engage in any abusive, unfair, or deceptive practices. They can't call you at inconvenient times or places. They can't call you at work if they're told not to call there. And they can't engage in any threats of violence or obscene or profane language. And if you do have any problems with debt collectors, you can report them to the CFPB or FTC, and you absolutely should do that because there are specific rules that they should be following. Now, we're going to get into some specific forms of debt now, and we're going to talk about student loan debt in particular, and we're going to be talking about federal loans, not private loans, because there are general repayment strategies for federal loans. And so student loan debt is, of course, money owed on student loans. It's sometimes the biggest debt that people will ever have, and it's often a stressful topic. Now, if you don't pay your student loans, as with many other loans, you can have to pay more fees and interest and face wage and account garnishment. However, with student loans, you can also be unable to get more federal student aid if you don't pay them and have to take one or more semesters off. You can also face negative entries on credit reports, a decrease in scores. You can have the decreased ability to borrow money, and you can also just have the stress of owing money and have a delay in reaching other goals. Now, there have been a number of changes to the repayment options of federal student loans. We don't necessarily know exactly what's going to happen. There's still a lot of things up in the air, but as of right now, with what we know, the crossed out plans will be going away after July 1st of 2028, and we will be left with the plans that are not crossed out: a general income-based repayment plan, a new repayment assistance plan, and a new standard repayment. So with the Big Beautiful Bill Act, the current payment plans will stay in place until July 1st of 2028, unless after July 1st of 2026, you have consolidated a loan, borrowed additional loans, or started borrowing. So depending on where you are in your repayment and your repayment goals, keeping your current plan or changing a plan may benefit your situation. It really depends on your specific repayment situation. But just to go over some of the new plans very briefly, with the new standard plan, previously the total balance was fixed into a 10-year payment plan. Now it really depends on loan balance, and the years set before they're paid off are on a tiered repayment schedule. So up to $25,000, the fixed repayment plan is 10 years, 25 to 50, 15 years, and it goes on down with the chart that you can see here. And then we have the new repayment assistance plan. So previously, repayment plans based on income had several options with offer payments as low as $0. Now the repayment assistance plan is based on a percentage of your adjusted gross income and amount borrowed. There's a mandatory minimum payment of $10, a $50 reduction per dependent, and it's set for 30 years or until the balance is paid off. So you can see the chart of adjusted gross income. So up to $10,000, annual wrap payment is $120. So that comes out to $10 per month. And then it goes on down from $10,001 to $20,000 is going to be 1% of the adjusted gross income. And then it goes up from there. So based on where you are in your repayment, changing to one of these plans may be good for you. That is something that you may want to explore depending on where you are. Now, some other student loan terms are things like a grace period, which is the period of 60 days after graduation or exiting higher education before student loan payments start needing to be repaid. So you have a little bit of time there. There's also forbearance, which is a temporary postponement or reduction of payments due to financial difficulty, which can be applied for through your servicer. There's also deferment, which is a temporary suspension of loan payments for very specific situations. Now, there are also certain examples where you can have loan forgiveness, cancellation, and discharge. There's closed school discharge if you're in the event where your school is closed before graduation. There's also public service loan forgiveness, where if you work for a US-based governmental nonprofit or a government a level of the government, if you make 120 qualified payments in either an income-based repayment plan or the standard plan, you can qualify for forgiveness. There's also the teacher loan forgiveness, where if you work 5 complete and consecutive years at a low-income school or educational service industry, you can receive a certain amount of your loans forgiven, and you can receive both this and public loan service loan forgiveness. However, the payments do not apply to both. If you get teacher loan forgiveness first, you have to make different payments for public service loan forgiveness. There's also total and permanent disability discharge. So if someone is totally and permanently disabled, they can submit that paperwork to their servicer and get their loans discharged. Student loans are also an example of loans that are discharged upon someone's death as well. So we're also going to get a little bit into some other debts. For example, title loans, payday loans, earned wage access, and pawn shop loans. So there is something known as car or vehicle title loans. So these are loans for a small amount of money for a short time. The vehicle title is the collateral, and a single payment loan often due in 30 days. These can also be loans that are generally very expensive. They can have a lot of fees and quite high interest if they are not paid on time. Now, we're going to talk a little bit about payday or payday advance loans. And here we have an example which shows a little bit of the debt spiral that people can kind of fall into with these types of loans. So here we have the example of a borrower visits a payday lender in person or online to get a new loan, or a borrower reborrows a prior loan. So the borrower then gives the lender a personal dated check 14 to 30 days in the future, or gives permission for an automatic withdrawal from an account. The lender then gives borrower the amount of the loan. When the loan is due, if the borrower doesn't have the check, doesn't have money to cover the check or withdrawal, the loan may be reborrowed with more fees. Then the borrower visits payday lender in person or online to get a new loan, or the borrower reborrows a prior loan. So I think it's easy to see with this cycle how you can kind of fall into a spiral of debt a little bit with these kinds of loans. And so we just encourage you to use caution when engaging with these type of loan products. Now, we wanted to talk a little bit about earned wage access as well, which these are being seen as a new approach to payday loans. And these are available through a number of apps and even employer payment platforms now. And they are billed usually as just giving you access to your paycheck early. However, they have transaction fees for each advance. And often they even make emotional appeals for tips when you request an advance. And they are connected directly to your bank account. So the money is due and automatically collected on payday. And if there are insufficient funds, the collection is tried again and again until the loan is paid in full. And these companies bill themselves as having no interest. However, this is not the full story, because it's important to also look at the APR, or the annual percentage rate associated with these types of loans, because this calculation also accounts for the transaction fees and how long you have to pay it back, as a lot of times these earned wage access type cash advances can often be due back the day after you take it out, making them very expensive loans. So looking at common types of advance loans, we have something like a credit card cash advance, which has an APR of 36%, usually caps out around there. You also have a typical payday loan, which has an APR of about 391%. Then you also have earned wage access, which can have an APR of 1,465.35%. So you can see here how these are actually very, very expensive loans. And if they were fully transparent about these kinds of numbers, you can see why they prefer to say the no interest number than posting these. And so we just encourage people to use the same level of caution that they would with payday or payday advance loans, that they would with these earned wage access apps, because they have the same potential for debt spirals, although these have the new marketing and they try to bill themselves in kind of a different way than the classic payday or payday advance loan. Now we also have pawn shop loans, and this is where you have an item you pawn is the collateral, and there's a loan amount, which is usually 25 to 50% of how much a pawn shop considers the item to be worth. And then you repay the loan, renew it, or you would lose the item. Now we're going to talk a little bit about protecting your assets. So there is bankruptcy, and there's either Chapter 17 or Chapter 13. So Chapter 7 bankruptcy is known as liquidation bankruptcy, and this is where assets that are not exempt are collected and sold, and the proceeds are distributed to creditors. However, with this type of bankruptcy, you are required to meet with an attorney to determine eligibility to repay debts via a means test. And then with Chapter 13 bankruptcy, this is also known as a wage earners plan. And this is where debts would be broken up and repaid over 3 to 5 years. However, it's very important to know that only lawyers can give legal advice. We don't and won't, as financial counselors, tell clients which one is right for them. We cannot give any legal advice. So if that's something that you're interested in discussing at a financial counseling appointment, that is not something that we can or will do, just so you are aware of that. So I want to thank you for listening to this talk about making a plan for debt. To schedule a one-on-one financial counseling appointment, you can email financialservices@sfcenter.org. And then if you have questions, please put them in the chat. We do ask, though, that you keep them kind of general. If you have questions about your unique financial situation, please email them or wait until your one-on-one financial counseling session, just to protect your privacy and so that we're able to best assist you.
Let's see if we do have any questions. A lot of thank yous. If you don't wanna share your questions with us today, please contact us. Okay, you can schedule your appointment. If you're struggling with debt or you don't know how to manage your debt, please contact us or any of the financial counselors in the library, because you're not alone and you don't have to go through the whole process by yourself. Okay, I know dealing with debt can be very overwhelmed, but you don't have to do it alone.
Thanks so much for that last note, Andrea. Yeah, debt is definitely, it can be a very overwhelming process. And so we really appreciate you and Tori coming to talk to us all about it today. So thanks so much for that informative presentation, and thank you all for joining us today. We hope to see you sign up for a San Francisco financial counseling session, and we hope to see you at our next webinar. That's coming up on December 3rd for slaying the holiday season, some tips and tricks to make sure your budget is in shape for all that holiday spending coming up. But yeah, thanks so much, everyone. We hope you all enjoy the rest of your afternoon. Jonathan, any last parting words, announcements, things that you want to add?
Oh, just thank you, Tori, for that great presentation. And yeah, I'll just reiterate that the library is here to help you navigate the these resources. So if, you know, you have questions about where you can get help about certain things, often we will direct you to our colleagues at San Francisco Financial Counseling because they're the experts in these matters. But we can also help you if you're looking for other types of help or resources. We can guide you through what's out there. So feel free to contact us. I put our department's email and phone number in the chat. And yeah, thank you, Andrea, and Tori. And thanks everyone for joining us this afternoon. Really hope to see you at our future events.
Guys, there is one more question by Bianca. Tourists are using other loans, 401k loans to pay it off debt. It's gonna be recommended, but it's gonna be depend of what cases we're talking about it and the amount of your debt, okay? Usually when we use another loan to pay any of your current debt, it's gonna be evaluating what loan it's gonna benefit you in a year, 2 or 3 years for your long-term goals. And it's gonna base also, I mean, what I do with my clients is like evaluate if actually worth it for them. And but if your debt is a little bit high and you can reduce your interest for 1 or 2 years, it's recommended. But I would recommend you to schedule an appointment so we can look at your credit report, we can look up the amount of debt, and also because we want you to make the right decision, and the right decision is something that actually fit for you and you feel comfortable to do it, okay? But that's all. I don't think we don't have any more questions.
Great. Thanks so much, Andrea. And thanks so much, everyone. We hope to see you all back soon. Take care.